ARK Invest and Cathie Wood just launched their newest ETF, and it's actually the 8th one in their package of ETFs, just so many. And this one is called ARKX, the ARK Space Exploration and Innovation ETF. Of course, it's innovation too, because that seems to be their company tagline. So obviously there's a ton of hype around anything these guys do. You know, ARK is like the biggest name in the markets right now. So in this video, we're going to cut through all that hype and analyze the real risk of buying this ETF. I know, it's so annoying that I'm once again killing the hype to talk about risk, but I'm telling you, it's important. To be successful in the markets long term, you need to be a risk manager more than you need to be an investor. You got to not only look at the upside, but look at the downside as well so that you can protect yourself. So even if we're talking about space, we still got to stay a little grounded here. So first, let's break down what exactly this ETF is. So they're saying by investing here, you're going to get exposure to space exploration, including orbital and suborbital aerospace, enabling technologies and beneficiaries of aerospace activities, such as agriculture, internet access, global positioning systems, construction, and imaging. Now, from that description right there, you could already see this ETF is going to be very broad. So they're defining space exploration here as leading, enabling, or benefiting from technology-enabled products and or services that occur beyond the surface of the Earth. So anything that has to do with space. So we got orbital aerospace companies, and these companies launch, make, service, or operate platforms in the orbital space, including satellites and launch vehicles. Then we got suborbital aerospace companies. So these guys launch, make, service, or operate platforms in the suborbital space, but do not reach a velocity needed to remain in orbit around a planet. So they're right below space. Then enabling technology companies. So these are the companies that develop the technologies used by all the other space companies. So artificial intelligence, robotics, 3D printing, materials, and energy storage. And then we got aerospace beneficiary companies. So these are the ones that will benefit from all this space stuff going on. So GPS, construction, imaging, drones, air taxis, electric aviation vehicles. Once again, very broad. And the ticker symbol here is ARKX. You can see on their first day what they lost like 1%. Not that this price action even really matters, but just interesting to see. So what exactly is this fund holding? Well, we could break it down right here. Number one holding is Trimble, which is a pretty popular space company, but the second holding is the 3D printing ETF from ARK itself, PRNT. So there you go. You buy this ETF and they're investing in their own ETF. So you're getting exposure to both. Basically like a Russian nesting doll at this point. And I would not be surprised if ARK created another ETF that just invests in all their ETFs together, a super ARK, but we'll stay tuned for that one. Going down this list, I see JD.com on here, which is kind of like the Chinese Amazon. You got JD and oh boy, look at this. You got Alibaba too. And they even got Tencent here. Not entirely sure what these companies have to do with space, but you know, everyone wants to please the CCP nowadays. Shout out to H&M. Some other companies I see here, John Deere. Interesting, very useful for when we have to plow our space fields, because we are definitely to that point right now. Amazon.com, absolutely crucial. If you run out of underwear up in space, you need that one-day delivery. Google, in case anything breaks in space, you can Google how to fix it. Netflix, when you decide, you know, space is kind of boring, it's just pitch black everywhere, well, you could turn on your Netflix subscription. This makes sense. As we said, this is clearly an extremely broad ETF. Jim Cramer himself says there's no reason for ARK's new space ETF to even exist. And look at this sassy little picture with his hand on his waist saying, no, I don't like this. He is as skeptical as we are. He said, one look at the newly launched ARK Space Exploration ETF tells you everything you need to know about how managers can't resist creating new funds, even if there's no reason for them to exist. And we'll dive into this a little more in a second. But Cramer is perplexed to why names like Amazon, Alphabet, and Netflix are included, along with Chinese e-commerce plays, like all the ones that we mentioned, and even John Deere. He said it's ridiculous, but there aren't enough genuine space-related stocks to make a decent ETF. And the manager still wants to collect that 0.75% expense ratio. Maybe don't launch a space ETF if you have to pad it out with Netflix and Deere. So what is going on here? Because this is supposed to be a space exploration ETF, right? Well, Barron's has an article explaining why Cathie Wood's space ETF has some unexpected holdings. And some ARK employees actually comment in this article. So they're saying that ARKX isn't limited to companies directly involved in the space business, but also other innovations that have indirectly enabled the space boom. Like Google, it's a leader in artificial intelligence, which is important for space. NVIDIA manufactures computer chips that allows rockets to operate efficiently. Well, if that's the case, then AI and chips are pretty much involved in everything, right? Sure, we already talked about the fund's second largest position, which is in another ARK product, ARK 3D printing. And they say that's because many rocket parts are 3D printed for reasons related to cost, weight, and durability. This is Ren Leggy. He's a client portfolio manager at ARK. Now, to be sure, you know, that 0.66% management fee, they are fully rebating it back to ARKX investors. They're not going to double dip. Don't worry, guys. You're not paying double layer fees. We don't operate like that. Oh, thank you. So nice of you. Now, e-commerce giants like Amazon and Alibaba are included because they can save delivery costs and generate revenue from drones if that market matures and scales. Okay. Netflix, another holding, could potentially unlock millions of new users as satellite broadband connects more people to the internet. There are 3 billion people who do not have access to the internet. Satellite connectivity opens up the market. It is really about anything above ground. I love ARK because they are always stretching as far as they could possibly stretch to make something sort of make sense. And I mean, if that's the case, if we're going to put anything that can benefit from space into this ETF, why don't we put Yum Brands into there? Of course, eventually we're going to have a Taco Bell drive-thru up in space, right? You know, astronauts get hungry. And up there, it's always the middle of the night because it's so dark. So where are you going to go for that late night cheesy gordita crunch? And you know, why don't we put Coca-Cola into this ETF as well? Because astronauts will get thirsty too. They need Coke. Nike is another company extremely important to put into this ETF. We need top of the line fitness gear so our astronauts are always prepared to run away from aliens. You know, it is absolutely shocking that there is no Tesla in this list because according to ARK and Cathie, they're going to get into every single business. They are the new Uber on top of completely changing the energy paradigm in our world. And are you saying that we're not going to create solar powered rockets? I mean, we're talking about innovation and disruption here, so anything is possible. Really, we should put the entire S&P and NASDAQ into this ETF. It's the only way to go about it. But no, I'm just kidding. We can't put a company like Tesla into here. Its stock price is falling too hard. And ARK is already getting screwed by that in this ETF, their innovation one. So no, we don't need more exposure to Tesla. Now, a lot of people are wondering why none of the new pure play space companies are in this ETF. There is a whole bunch of pure space plays that are coming to market through SPACs. The market cap of those 7 companies is roughly 16 billion, based on the number of shares outstanding for each after their SPAC merger closes. But none of them are in the ARK Space Fund's portfolio. So what gives? Well, they said they're open to adding these SPACs to their ETF, but they need to review more financial data first, because before the whole SPAC merger happens, there is not enough data. They also have very high valuations, which is causing ARK to wait on some of them. They said they fit our theme, but from a valuation point, they don't meet our hurdle rate for the next 5 years, because what they're looking to do with this fund is provide investors with 15% annualized returns. So they said they're going to be patient and continue to track them, and if we get an opportunity, we will leg into it. A lot of them are very interesting. So this is very prudent. I would be shocked and scared if they were investing in SPACs with this ETF. So this is a good thing to see. Now, their number one competitor is the UFO ETF, which is another space ETF. And they too are not invested in any SPACs because there's too much risk. Tremendous risk, actually, which is what their CEO says. Then you're looking at a company that doesn't have any space exposure other than a proposed target. So yes, it absolutely makes sense to wait. And speaking of this space ETF UFO, it is definitely a pure play on space because more than 80% of its portfolio has to be invested in companies whose majority revenues are derived from space-related businesses and activities. The remaining 20% are diversified in aerospace defense names like Boeing and Lockheed Martin, which generate a significant amount of revenue, but not all of it from their space-related units. So Andrew here, the CEO of this company, basically said what we're saying. Anyone can argue that almost every publicly traded company has some exposure to space, or space plays a role in that company's ability to succeed. For us, though, it's not about making nuanced arguments about how maybe a company could potentially benefit from space. I think that's a direct shot at Cathie Wood, and they are competitors. But I agree here because, like I was saying, literally any company will benefit from space, just like any company will benefit from technology. We could call pretty much every company a technology company now because there is a lot of technology involved in each one. It's not like the 90s where some companies were tech companies. Just like all companies are tech companies right now, in the future all companies will be space companies too, or at least benefit from space in one way or another. Or an even better example, all companies will be AI companies as well. So why did ARK even start this ETF, and what is the risk of you investing in it? Well, in my opinion, I'm not really a fan of this ETF because it's just way too generic and broad. Netflix should not be in there. If you are really looking to get exposure to space plays, you're better off picking your own companies. What you can do is just put small allocations into specific companies that you find and kind of build your own ETF. Because what's the point of an ETF like this, right? Like, sure, you are spreading out the risk by investing in a number of different companies, but this is also so many companies in so many different industries that really you're not getting the direct exposure that you're looking for. Companies like Amazon and Google, they're not going to move based off what happens to the space part of their company if they even have one. Yes, Netflix will benefit if more people have the internet, but what company wouldn't benefit from that? That just seems like a weird reason to add it into this space ETF. And here's the risk with really any fund manager, including Cathie Wood and all of them. They don't actually have your best interests in mind because they're really playing their own game. And that's kind of what Kramer was alluding to right here, because every manager wants to collect that expense ratio, those fees. That's why this is like the 8th ETF ARK is launching. Are they launching this ETF because they truly believe believe there's a huge opportunity here and this is the best way to play it? Probably not. But they know they have a lot of momentum behind their name right now, and it really pays to launch as many ETFs as you can because people are going to eat them up. See what happens in the professional world. If you're a fund manager, it's not all about making returns in the market. Oftentimes, that's the last thing you need to do. The first and most important thing you need to do is raise money, because this 0.75% fee, it seems like nothing, right, for us when we're investing. But when that company or fund manager has billions and billions of dollars, that's a ton of money. And you don't even really have to do anything. That's why so many mutual funds, they don't beat the market, they just match the market. You'd be better off investing in an ETF, but these fund managers get away with it because that's how the industry is. In fact, they get penalized if they do something different from the market. There's something called career risk, because if you outperform the market, okay, you may get a bonus as a fund manager, but if you take that same risk and underperform, you're going to get fired. So that's why most managers, like mutual fund managers, are closet indexers. They just want to do exactly what the index is doing and exactly what everyone else is doing, because if everyone does the same, because if everyone tanks and everyone's fund falls together, then you could say, hey, yeah, mine tanked, but that guy's tanked too. The whole industry went down, don't worry about it. And if everyone's doing the same thing, how are you going to get fired? You're not. And you're going to keep collecting your fees on that huge amount of money, so it turns into a pretty good business. But the idea, once again, is raise as much money as you can so that you have that billions that you could charge that small percentage on, and there you go. You're like a rent seeker. So when you think about these managers and you think about these funds, you got to understand what are their incentives. It's not always to beat the market and do really well for their customers. It rarely is, I would say. It's more about how can we raise the most amount of money. Another good example of weird incentives is Bill Ackman. Now, he is a legendary investor by this point, right? But do you know how many funds he's blown up? Huge billion-dollar funds, driven them right into the ground. And you know how many stupid calls he's made, right? Like on Herbalife, riding that into the ground. Well, here's the thing. It can look stupid from an investing standpoint, but from an actual business fund manager standpoint, he's doing the most optimal thing for him to make money. Like at the end of the day, after all these funds blew up, he still made $1 billion himself, right? He is a billionaire. Well, here's another thing these big time hedge fund managers can do. They can make really big calls, and they don't practice risk management, right, on that call, because they want to be known as the guy who said, hey, this is going to happen. And if it plays out, you know what happens? They make way more money in the future, because for their next fund that they raise, they start getting billions and billions of dollars into it. So basically what you do is you make a crazy call, like I think China is going to collapse, and then you beat the drum about that constantly. And then on the small chance it happens, yeah, you make out like a bandit. And if it doesn't happen and the fund goes to zero, you just start a new fund and you go on a new crusade. But it's all about getting your name out there so that people know you and they give you money. Stupid things are constantly happening in this professional industry. You just saw recently that Tiger Cub fund blew up. They were over leveraged like crazy. The bank gave them so much money. Why? Again, stupid things happen. And you start wondering, do any of these managers practice risk management at all? A lot of them don't, because again, different game, different incentives. They're not looking out for you. So there's always going to be some real risk when you're investing with people like Cathie Wood. And I'm not even saying they're bad people either. It's just the game. Cathie herself is on the brink of crashing her ARK funds with the way she's doing things and the market we're moving into. We actually explain what's going on in this video right here. And not only do we explain why these funds are at risk, but also what you should do about it, because it's going to have a huge impact on the stock market and all of our portfolios. So if you want to see how to protect yourself, click this video right here and I will see you there.